How's it going, everyone? Welcome back to the Invest in Wealth channel. Today's video, we're going to be doing a complete portfolio breakdown here. I recently made some massive changes to the portfolio, completely switched up my investment strategy. So we're going to go over that today. I'm going to kind of explain my thought process here with the portfolio, kind of what my goals are in the future. So currently we're sitting at a balance of $196,203. That is broken down to of my tax-free savings account, which we are up 43%. My first home savings account, which we are up 15.6%. My RRSP account, which we are up 38%. And then my non-registered account, which we are up about 18%. So why do I have this non-registered account here with such a large balance is because my RSP, my first home savings account, and my tax-free are all at its limits. So I'm just waiting for 2025 to get that new contribution room to my registered plans, and I'll either just deposit it into the account or move my non-registered money accordingly to my registered plans. So I did make a massive change here to the portfolio. I've completely sold off basically all my individual stocks except for a couple here of my small positions. So what I did, my goals for this portfolio, I completely got rid of I owned a lot of individual Canadian stocks like Bank of Nova Scotia, TD, RY, Bell, Enbridge I own a lot of. Those Canadian companies have been quite flat recently. I thought it would be, for one thing, it was a little bit more tax efficient because I did own a lot of those banks in my non-registered account, and they produced quite a large amount of dividends, which I do have to claim at 100% of my tax rate. And the price has just been flat over like the last few years that I've held them. So I bit the bullet. I completely sold all my individual Canadian holdings, and I just bought some ETF which we will go through now. So kind of what I wanted with my portfolio allocation for US ETFs, I wanted 65%, which I wanted to split between VFV. So my target with VFV is 40% of my portfolio. Currently it is 33%. So I will be adding some more to VFV. I'm sure you guys know, but this is the Vanguard S&P 500 index. So I want this to be 44% of my portfolio. The rest for my US allocation, I am going to split between 3 different tech ETFs that hold tech companies. So first off, in my tax-free, I own TXF. This is actually a covered call tech ETF. So this tracks the top 25 of the largest technology companies with covered calls. So the yield is quite large here. I did have quite a big position in my non-registered account, which I completely sold off and bought HXQ. So HXQ, it's very different than TXF. It's not a covered call, plus they don't pay any yield. So this is perfect for a non-registered account. As you can see here, got about 22,000 in this, all in non-registered. So they basically just reinvest the dividend back into the fund. So it is quite tax efficient if you're holding this in a non-registered account, which I am here. Again, this is just a NASDAQ 100 ETF, very low fee as well. So I own TXF, HXQ, and then another one here. I do own this in my first home savings account and in my RRSP. So this is kind of a global tech index ETF, mainly made up of the US couple Canadian, couple international companies in here. Small yield as well, but I do own these in 2 registered accounts, my first home and my RRSP. So all those 3 combined make up about 25% of my portfolio. So then that just brings me with about 7% that I want to build on my US exposure, which I want to add to VFV. My target for Canadian geographical diversification, so for Canada, I own 2 ETFs to get my exposure from them. So the 2 Canadian ETFs I own is VDY, which is a high dividend yield index, because I do still want a bit of income flowing through my portfolio. It's just nice to kind of reinvest that. So VDY has about 4.6% yield. So invest in a lot of high dividend Canadian companies like the banks, the energy, which I owned individual stocks with previously. This kind of diversifies me, as well as now instead of owning those high dividend stocks in my registered account, or sorry, my non-registered account, which I did have to claim those dividends as income, I now just own 1 ETF, and I own it in my tax-free savings and in my RRSP. So none of the dividends I get taxed on, which is nice. So this just tracks mainly large, mid, and small cap Canadian stocks with above average dividend yields. So we're talking again like the banks, the energy, the utilities. So I'm still getting exposure to the individual stocks I own. Now it's just all in this 1 ETF here. Still getting a decent yield as well. And now I don't have to pay tax on it, which is great. The other Canadian ETF that I'm getting my 20% exposure to is ZCN, which tracks, I think it's roughly 200 Canadian companies. They do pay decent yield as well, 3%. This one I own in my tax-free, as well as a large position in my non-registered. I will have to claim tax on the dividend, but that's all right. Mainly holding this one more for the Canadian growth. They have, like I said, 200 companies, small, mid, large cap Canadian companies. So those 2 funds I want to make up about, my target is 20% of my portfolio. So this one here I want 15%, and then VDY I want 5% to make up that 20. So I think VDY is at 4% of my portfolio. So I will be looking to add into that one. For my international exposure, I want to keep it under 15%, 10 to 15% for my international exposure, because it is a little bit more risky. I do own a global real estate that it's a very small position, but it gives me a little bit of exposure globally. I also own XEC. So this invests in the MSCI Emerging Markets Index, as well as XFH. This is the MSCI EAFE International Market Index. I like the Canadian hedged one as well. Just takes out a little bit of the currency risk. I do also own just a straight up China equity index as well to get a little bit more of the China exposure. I do believe China's economy is very undervalued right now, and I'm holding all this for the long term. So I do think this is a great buy. So these 3 ETFs, as well as a little bit of this global real estate fund, right now it's roughly about 11% of my total portfolio, but I'm looking to add into these funds just to increase that international exposure. All right, let's dive into the actual accounts now, starting with the tax-free savings, so we can see kind of what I'm holding in there and my returns over the past few months or so. So in the tax-free savings account, it's worth about $45,000. So I do own a REIT inside here. I want a bit of real estate exposure, for this portfolio. Generates a lot of income. That's why I am holding it in my tax-free savings. This is Allied Properties. It's one of my favorite REITs right now, paying almost 11% dividend. I do believe REIT sector will bounce back quite heavily when interest rates start to fall even more here. I do see a lot of value with Allied Properties. So I do own this in my tax-free savings account. My other holding here, TXF, which I already went over. I get a lot of tech exposure here. Plus it has a covered call, so I am getting that nice yield as well. VDY, Canadian High Dividend Yield Index. So again, you're starting to notice a pattern. A lot of the high dividend ETFs I am holding in my registered accounts. So VDY. Then we have VFV, which is by far the largest holding in my portfolio. Makes up about a third. This I'm just going to shelter the capital gains growth on it. Holding all these ETFs for the long run. So we got a bit of VFV exposure here. And then ZCN, which was that TXS ETF that tracks about 200 Canadian companies. So all these 4 ETFs and that one REIT make up my tax-free savings. All time I'm up about 43%. In the last year I'm up about 21%. Last 3 months up about 3%. Last month we're down 2%. Last week we're up about 3.6%. And then the last day, which we won't really go over. Next up, we have my first home savings account. Not too sure the time frame for this account, but I do love getting that nice tax deduction at the end of the year. Helps out a lot. Roughly about $2,200 for that tax deduction. Not too concerned about being so aggressive in this account. Not really looking for... Normally in a first home savings account, you want to be a bit more conservative, mainly because the money is going to be used for a down payment towards your home. Also, the time frame is normally shorter, so you don't really want to take too much risk when your time frame is shorter. But in my case, not too concerned with that, mainly just using this account for that nice tax write-off, plus all the earnings are tax sheltered. So in this account, I own that tech ETF. So this is the Global Tech Leaders Index ETF. Again, we have VFV just for that growth. Then we have the Emerging Markets ETF. And then we have another international ETF as well. So we got that mainly US and international exposure here. No Canadian exposure in my first home savings account. But again, don't mind being too risky in here because this 18,000 makes up a very small percent of my overall portfolio, so I can afford to be pretty risky here. Next up, let's look at the biggest account, which is the non-registered account. I do have 3,000 cash, which I will be transferring to my RRSP tomorrow, which will cap me at my contribution room for the year. So that's nice to see. So in the non-registered, I do have a small position of Apple here, that global real estate ETF, big position in HXQ, which is the NASDAQ 100 index, which has the no yield, HYLD, US covered call ETF. This one does pay a high yield, but don't have too much in it. Gives me a bit of US exposure as well, plus a little bit of income, which I can reinvest in my non-registered account. I own MEG, so this is the Magnificent 7 ETF. I'm sure you guys are all familiar with the Magnificent 7. Very small position, but gives me a bunch of exposure to Apple, Nvidia, Amazon, Microsoft, Google, Meta. So yeah, small position there, but pretty risky. Just invest in those top 7 companies, equally weighted. Small position of Nvidia here, which I just started. I saw some value in Nvidia, so I grabbed a couple shares. VFV, very large position here. Holding this in my non-reg because VFV's yield is just over 1%. Plus, I know I do have that capital gains. If I do ever sell, I'll have to pay tax on that. But that's way more favorable, as you only have to claim half the capital gain on your income, unlike dividends where you have to claim it 100%. And then we have our emerging markets ETF, XEC, XFH again, international ETF, XSU. This is US small caps. I really like this kind of to diversify my US exposure. So instead of buying, VFV has a lot of basically 10 companies make up about a third of the index. So buying small cap gives me a lot of exposure to different US companies. That's kind of my thought process there. We have our China equity index ETF, and then our Canadian exposure, which is ZCN. So in the non-registered account, all time we're up about 18%. Last year we're up about 12%. Last 3 months we're up about 4%. Last month 1%. Last week 3.6%. So decent returns here. Lastly, we'll look at the RRSP. So we do have Tech, VDY, VFV, and XEC. So nothing new. I'll be adding 3,000 to this tomorrow. I'll probably just buy that REIT, Allied Properties, in this, and then maybe add to VDY to try and get that to my target 5%. All time we're up 38%. Last year we're up 30%. Last 3 months 4.3%. Last month we're down 2.7%. Last week we're up 5.3%. So with making those big changes with selling my individual Canadian stocks and buying ETFs, it did lower the dividend yield of this portfolio by quite a bit, but that's all right. I just, like I said, I just bit the bullet. I think it was a very smart move. It's very hard to outperform the market. I do like where my portfolio is headed now. It's kind of more of a passive approach, but hey, say I wanted to pick up 10 grand in an individual company, then I still have the power to do so. All the decisions are still in my hands here, but just to kind of wrap it up. So my target, US 65%, Canadian 20%, international global about 15%. And that's not set in stone. I'm sure things can change and I can make kind of mess up with that allocation a bit, but I'm pretty happy where things are at. We're making decent returns. I've kind of shifted from a dividend portfolio more to a growth portfolio. Still getting a nice yield, still getting some income, but I think I'll be better off kind of shifting away from the individual stocks to ETFs. So if you guys have any questions, you can always leave them down below. But yeah, hopefully you guys learned something new. Hopefully you guys enjoyed the video, and I'll see you in the next one. Thanks. Bye.